Welcome to the FEDLIFE Podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
Hello and welcome to this episode of the FEDLIFE Podcast. As you already know, if you're a regular listener, I'm your host, Dan Sipe, and additionally, I'm the branch manager here at Serving Those Who Serve, Enrollment, Sipe and Associates. And I want to begin, as I always do, by saying thank you. Thank you for taking the time to listen to us today, and thank you for your service to me, every single person in the United States, for your service to the government. You don't hear it enough. You'll always hear it here. The other thing you'll always hear here is Ed Zurndorfer. Once again, the guru is back with us as part of our ongoing mission to reach, teach, and serve you. Now, at the outset, I need to say the opinions of our guest, Ed Zurndorfer, are not the opinions of Raymond James or Serving Those Who Serve, and this podcast is presented for information only and not intended to be taken as advice. All listeners should consult their personal advisors before taking any action, and if you don't have one, hit us up at Serving Those Who Serve. We'll help you any way we can. Once again, we're going to be following Ed's FedZone articles as part of the way that we can reach, teach, and serve you. So we're in Life Insurance Awareness Month, and Ed wrote 3 articles on that. So we're sort of in the middle in the way that we're working through this. So we ended up speaking about FEDLIFE the last time. And now we're into the second article where we talk about taking private life insurance as a supplement or possibly as an alternative to FEDLIFE. And Ed, you begin with the factors that are considered by insurance companies when folks apply. So walk us through that.
Okay, Dan, I'm going to go through the various factors that insurance companies use in determining if a person is insurable, as well as the amount of their insurance premiums, what they're going to be paying, because life insurance premiums, when it comes to term insurance policies, can vary. You can be rated super, or you could be approved to have a super preferred rating. Yep. Or you could be all the way down. You could be what's called tabled. You have some real health issues in which you're going to pay much more in premiums. So here are the factors. 1, age. And that's probably the most important factor, because as we know, life expectancy, as we get older, our life expectancy is decreasing. And that would be probably the biggest determination of risk for the insurance company. You know, the risk for the insurance company is you're going to die and they got to pay out the proceeds. So as you get older and you get closer to that day of death, the insurance company is going to be it's going to end up being more risky for the insurance company. So if you apply for life insurance when you're older, you will be paying a larger premium compared to if you bought it when you were younger. Next factor, gender. Since women, on average, live longer than men, and please don't ask me why, because I'll get myself in a lot of trouble. I'm not going to.
Yeah, let's just keep going past that one, Ed.
That's just a fact. I'm going to leave it as a fact.
It is indeed.
Okay. They generally pay lower insurance premiums compared to males of the same age and for the same face amount of the insurance. Next factor, smoking. Individual who smokes is statistically at a higher risk for many health issues that could shorten their life and therefore increase risk-based premiums that the insurance company charges. Health issues. The purpose of medical exams that the insurance company will conduct is that they require many life insurance applicants to be screened for health conditions, including things like heart disease, diabetes, cancer, and related metrics that can indicate the possibilities of a shorter longevity and therefore more risk to the insurance company. Lifestyle. Dangerous lifestyle can result in the insured paying more in life insurance premiums. Let me give you an example. I have a friend here in the community who does skydiving.
Oh, yeah.
I don't consider that to be a very, very, I mean, I'm sure they take precautions, but it could result in people ending up dying sooner than later. So,
sure. Deceleration syndrome from the sudden stop.
Yeah. So I think so what you do in your lifestyle particular hobbies that might be maybe considered to be more dangerous than other hobbies that could result in higher premiums. Here's a factor that's interesting: one's family medical history. Insurance companies have a lot of statistics, Dan. They've done studies that if a male is applying for life insurance, they're going to ask the question, did you have a family member, a parent, or a sibling who died of heart disease before age 60?
Oh, yeah.
A lot of statistics show that if you have heart disease in your family, and you're a male particularly, that heart disease, you're going to inherit that heart disease.
Sure.
And therefore, the few companies I have worked with in years have told me that if someone applies for life insurance and they did have a father or a brother, even a sister who died of heart disease before age 60, they're automatically going to get they're going to be paying a higher premium without even going through a medical exam. Okay.
Sure.
So this is another factor is going to determine what they're going to be paying in life insurance premiums. And the last factor is one's driving record.
Oh, yeah.
A history of moving violations or drunk driving can dramatically increase the cost of life insurance premiums.
Sure. Very true.
The insurance companies obviously have statistics. They're not making this up. They have all the statistics in the world. I always say that underwriting, when it comes to life insurance, is a science. It's not an
I agree.
art.
Yep.
It's not an art. Now, that's different compared to, let's say, long-term care insurance. That's a different animal altogether. Give you an example. When it comes to long-term care insurance, when you apply for a long-term care insurance policy, the insurance company cannot ask you about your family health history of anybody who had, let's say, dementia or who went to a nursing home. That's illegal. All the insurance company can ask you is, do you have dementia?
Right.
Currently. And of course, you'll say no. That's why I'm applying for the long-term care insurance. They only can ask you about your current health history. Let me give you another example when it comes to long-term care insurance. Diabetes. Diabetes runs in families. And there's an association of diabetes and heart disease. So when you fill out a life insurance policy, don't be surprised that they're going to ask you if there's a history of diabetes in your family.
Sure.
If one has diabetes and they're applying for long-term care insurance, as my experience, they're going to get rejected. As I said, diabetes many times runs in families. So let's say in your family, you have family members who developed diabetes, let's say in their 50s or 60s. They didn't get it when they were young. And here you're filling out a long-term care insurance application. The insurance company is going to ask you, do you currently have diabetes? And you don't. So you say no. The insurance company cannot say, is there a history of diabetes in your family? That's illegal with a long-term care insurance policy, but not with a life insurance application.
Sure.
That's important. So these are the factors that are the main factors that insurance companies use to determine, number one, if you are insurable, and also, Dan, what you're going to be paying in premiums. Because as I said a few moments ago, premiums can come in all types: super preferred, non-smoker, smoker, rated, whole gamut of premiums.
Gotcha. Now, Ed, you also press on and you share what you consider to be some of the best practices for picking a company or an agent or broker. Why don't you talk through those a little bit?
Yes. When an individual, and this, of course, includes federal employees, if they're going to go out and buy individual life insurance, I make some recommendations. Okay. They're encouraged to seek the advice of a licensed life and health insurance broker or an agent, someone who is licensed to sell life and health insurance. When I say life and health insurance, there are basically two types of insurance licenses. One is for life and health, in which the person who's licensed has that license can sell health insurance, life insurance, disability income insurance, as which is different than an insurance person who sells what's called property casualty insurance. What is property casualty insurance? That includes selling auto insurance and homeowners insurance. There is a difference. Now, some insurance professionals have both licenses. And what I'm saying here, if you're going to purchase a life insurance policy, you should go to someone who has who's licensed to sell has a life and health insurance license. I said an agent or a broker. I would personally recommend a broker, because what is the difference between an agent and a broker? A life insurance agent generally works for an insurance company, one insurance company, whereas a broker is not tied into any one company. Who are they working for? For you, the person applying for the insurance. You say to the broker, I'd like to buy a $500,000 term, a 30-year term life insurance policy. Can you search to see which companies would give me the best rates? And the broker will maybe contact 5 to different companies, see what their premium rates are in the various categories, preferred, super preferred, smoker, and sit down with you and compare the rates. In other words, Dan, the broker is not tied into any one company. The broker is tied into you. The broker is trying to get a commission here. You're not paying the broker for these services. The broker is only going to get paid a commission if he or she sells that policy. So they're going to do everything possible to make sure that the policy they're going to recommend is totally suitable for you.
Sure.
Another recommendation is that whatever company you go to, whatever company ends up to be the most attractive company for issuing you a life insurance policy, that the company be highly rated. Insurance companies are rated, Standard & Poor's, Dun & Bradstreet. And what I personally tell individuals when they're buying life insurance, you should never go with a life insurance company that has a rating less than AA. I'm talking about insurance companies can be rated as much as AAA or A++, sometimes they say A++, and it can go all the way down to D. What is D? Deficient. Now, why is that? You're buying a product here that may go on for as much as 30 to 40 years. You're buying a life insurance policy that's going to insure you, hopefully, you're going to live that long, but in case you die, the insurance company is going to pay out the proceeds, and this could be as much as 30 to 40 years away. You want to make sure that's a sound financial, that company has a sound financial foundation and rated accordingly. Very important. Very important. You look at the most recent rating of that company. And this is by the way, the broker would be able to provide that as part of their comparison. Okay.
Absolutely. No, that's important stuff, Ed. And the other thing that I like in your article is you kind of rounded out with 5 pretty good questions that you think our Fed should consider when they're on the topic of outside insurance. Why don't you take us through those?
Okay. The questions are the following. Here we have a federal employee, and they were interested in buying some individual life insurance.
Mm-hmm.
So the employee has now utilizing the services of an agent or a broker. Okay. And let's say the agent broker finds a policy, but the rating they get, the rating they're getting is not a preferred rating. In other words, they're going to be paying more of a premium. Okay. And In that case, the employee should ask the question, well, can I get another type of life insurance, maybe with a higher premium, maybe more life insurance, or a different type of policy? Ask that to the person. Ask that to the agent or broker.
Sure.
Number two, does the employee want to replace all of FEDLIFE? Let's say they have the option, they have to have the basic. In order to have any of the optional coverages, Dan, you got to have the basic. Should they replace all of their everything, or just parts of it?
Well, Ed, I know we're not supposed to give out answers, but I am no fan of getting rid of basic. So I'll throw that in.
And I agree with you. I agree with you for the simple reason that, as we discussed in our most recent podcast, Dan, I know I ask you all the time, but am I allowed to?
Oh, absolutely. Plug away.
We just did a FEDLIFE webinar. We
sure did.
We do monthly webinars. We do monthly webinars, and we have a webinar on FEDLIFE. That's not held every month, though. We just had one last Friday. Our next FEDLIFE webinar, where we go into a lot of detail about what FEDLIFE is, the cost, both for your employee and when you are retired, will be, I'll give the date here. It will be on November the 2nd, this coming November 2nd. I believe that's a Tuesday. I think it's a Tuesday. And you can learn everything you need to know about FEDLIFE. But the reason, Dan, I know you say, and I agree with you, that you should not get rid of all your FEDLIFE is because the FEDLIFE basic insurance amount that you have to have in order to have the optional coverages.
Right.
If you want to retain that in retirement, you can if you fill all the conditions. But here's what you got to realize. That if you reduce the amount of your FEDLIFE basic, you make that decision before you retire, and you reduce it down to 25% of what you have at the time you retire. For example, at the time you retire, you have your FEDLIFE basic insurance is $120,000. That will go down to $30,000.
Yep.
But it's free starting at age 65. When you turn,
we love 65. Free. Ed. We love free.
We love the word free.
Yep.
It sounds so good. And what can you use that free life insurance for? As a burial fund. So you should definitely not get rid of all of FEDLIFE. Keep that 25%. Okay. Now, as far as the optional coverages, Dan, especially option B, the multiple salary, that's something that if the employee can know, they can do better by buying an individual life insurance policy, especially if they're going to need life insurance well into their 60s or 70s, and they need that multiple. I encourage them that they should really engage the services of this agent broker, see if they could replace that multiple with a 20 or 25 year level term policy. And they would end up saving, in my opinion, a lot of money by getting rid of option B.
And that's, you're spot on, Ed. That's one of the things we do for people a lot through Serving Those Who Serve. We can do a side-by-side comparison on them, to help you see how you might do better there. Your question number 3 is kind of interesting because most people wouldn't think about it. And you asked, what happens if disability causes the employee to be unable to pay the premiums? So talk about that.
Yes. And I know there are individual life insurance policies that offer this. Is called Waiver premium. FEDLIFE, Dan, does not do that. FEDLIFE does not have this, does not have, I should say, a rider. And what it means is this: if the insured, the policy owner, gets disabled and they can't work, they get very sick, they get into an accident, they can't come to work, and they're unable, therefore, they don't have any income coming in. No wages, they don't have any investment income, they just don't have any income. I hope this never happens to anybody.
Right.
The fact of the matter is, they can't pay their premiums for their life insurance policy. They just don't have the money. Well, some individual policies offer a rider meaning you have to pay for this. But
Sure.
all it means is that if you get disabled and you can't pay the premiums, the insurance company is not going to drop you.
Yep.
The policy will be in force. Okay.
Nope. That's great. So number 4, you sort of introduced it. You ask, what are some of the riders and provisions available?
What are some other riders that insurance policies offer? Now, this one, which I think is very, very important, is something called an accelerated death benefit rider.
Mm-hmm.
Also, there's something called living benefits rider. Now, what the accelerated death benefit rider is, and by the way, FEDLIFE has this, that in the event a federal employee, let's say, who's enrolled in FEDLIFE Basic becomes terminally ill. What does terminally ill mean? They have a life expectancy of less than 9 months as diagnosed by their healthcare professional. Someone, God forbid, is diagnosed with cancer.
Gotcha.
The doctor has given the patient a life expectancy to live no more than 9 months. The employee can tap into their FEDLIFE Basic insurance, take the money out, Dan, tax-free, no penalty.
Yep.
And use the money for anything. What do you mean use it for anything? Let's say to pay off their mortgage. Let's say they want to give a gift to family members. I had an example of this. About 7 years ago, I did a 2-day retirement seminar at Griffiths Air Force Base, New York. And I was explaining about this accelerated death benefit rider, Dan.
Mm-hmm.
So a gentleman comes up to me during lunchtime. He said, I didn't want to bring this up during class, but I was diagnosed with leukemia a few months ago, and my doctor has given me 6 months to live. I have about $100,000 of FEDLIFE Basic, and I'd like to use that money. Would I be eligible to do so? I said, well, if your doctor says you got 6 months to live, definitely. You could tap into your FEDLIFE Basic tax-free. There is no tax consequences, and you can use the money for anything. He said, well, that's good to know. And then he said to me, what he'd like to do with the money, his mortgage is paid off. That's not the problem. His wife will be getting a survivor annuity. But what he likes to do is he would like to give a gift to his grandchildren. I said, how many grandchildren? He says, well, I have 2. I have twin granddaughters. They're age 3. And your opinion, he asked me, what would you think would be an appropriate gift for my granddaughters? I said to him, sir, the gift of education. Why don't you take the 100,000, divide it into 2, 50,000 for each grandchild, and put it into the New York 529 college savings program? You're talking about a 3-year-old.
Right.
Invested money, this 529 plan will be invested for 15 years by the time they go to college. You can get a lot of college paid for, tuition, room and board, things like that, in 15 years. You don't know how emotional I was giving him this information. And I said to him, look, if you need more information, here's my contact information. I'm more than happy to help you. And I never heard from him.
Sure.
I went back to Griffiths Air Force Base the following year. And I was very curious what happened, because I wanted to know if he passed away. And the agency told me he did pass away. Then they asked me, suppose he would have lived. Suppose he took out that $100,000 from his FEDLIFE Basic, used it all up, but by some miracle he lived. What's going to happen? I said, nothing. The only thing is he lost that life insurance. But the IRS is not going to come out and say, well, since you live, we're going to now tax you on that and penalize you. No.
Sure.
They're glad you live. So this is a very important feature of FEDLIFE that does not cost any extra.
Oh, I agree, Ed, because quick story here. This came in 1998. And one of the things that we've always done is when benefits are added, not everybody knows it happens. So, for example, back in 1998, that meant you got a piece of paper. Today, it means you got an email letting you know, hey, you're getting a new benefit. Well, people see that, people don't see that. Maybe they stay on top of it, maybe they don't. And we really felt it was important to take the time to reach out to all of our clients who are feds and say, did you know that this has been added to your FEDLIFE? So great, we did that. A couple of years later, I get a call from one of my clients and he goes, hey, Dan, remember when you called me and said there was that special benefit with my basic life? I got really, really sick. I could use it. And I went, yeah, what happened? He goes, no, it's not for me. He said, I have a colleague who has a lung condition and the health insurance company considers a lung transplant to be experimental surgery for his condition, and they don't want to pay for it. So the gentleman was able to, because he certainly would not have made it 9 months, he was able to access the full value of his basic life. And he was, to my knowledge, when I spoke with my client next, he had the surgery. And when they last lost touch with one another, he was still alive, and it was some 7 years later. Now, that is one great life insurance benefit.
Yeah.
That helps you stay alive. So,
Yeah.
So that's an excellent point. And let's, before we move on, let's hit your question number 5. When should an employee consider replacing coverage, if at all?
Yes,
that's a great question.
An employee, let's say they're early in their career, mid-career, maybe towards the end of their career, they have an existing life insurance policy, and for that matter, that would include FEDLIFE. They have some, let's say, a group policy. Should they replace their current policy?
Mm-hmm.
Okay, and when is the best time to do it?
Sure.
I'm saying that because let's say someone has, let's say they bought a 30-year term life insurance policy. Let's say when they were 25 years old, 30-year term, because at that time they had bought a house and they had some kids and so on. And they figured by the time 30 years rolls around, the mortgage will be paid off and the children will be on their own. Well, lo and behold, that didn't happen because when the kids went to college, they had to refinance their mortgage, the mortgage. So this happened when they were, let's say, 20, when the person was 25 years old, or 45 years old, 20 years later. So now that original policy, that original life insurance policy, 30-year term, is going to end when they're 55. They're going to need life insurance, probably coverage for at least another 20 years, take them out to age 65.
Sure.
So now at age 45, they should think seriously about replacing that 30-year term policy with a 20-year level term policy. In other words, don't wait until 55, because at 55, that policy is going to be up. You should replace it when you have to replace it.
Sure.
So I think this is where it's very important that you keep track of your life insurance needs, because your life insurance needs is just not a one-time calculation. As you get older, circumstances change, so will your need for life insurance.
No, makes perfect sense. All right, so let's now turn and head into your third article, where you get into the different types of private life insurance, and you open it up with annual renewable term. We talked about that in our previous podcast, but you go into a little more detail here as far as the advantages and the disadvantages of it. So why don't you talk about that a little bit?
Yes. Let's talk about the advantages. The advantage is that initially, Dan, the premiums are cheap when you first buy the policy because you're younger. The disadvantage is, I'm sorry, let me just add to the advantages, that the policy stays in force. You don't have from year to year. You don't have to furnish evidence of insurability.
Yep.
But now comes the disadvantages. As you get older and you become more of a risk to the insurance company, you're going to be paying more in premiums.
Yep.
That is a big factor here. As you get older, your insurance premiums are going to go up. Now, this is different than what we talked about with level term life insurance, in which your premiums, while initially are going to be more than what they were with the annual renewable term, are going to stay the same. And in that article, I have a comparison. This is a real life policy that I got from a website that does life insurance quotes. I think that column will be coming out today or tomorrow. Because I submitted it, I should say, yesterday. So it should be coming out, if not today, most likely tomorrow. And the listeners should look at that column and particularly see this comparison between a 10-year annual renewable term policy versus a 10-year level term policy. And they're going to notice that over 10 years, by getting the 10-year level term policy in the example, they're going to save $400 by going with level term. So once again, it is my favorite. Level term is my favorite.
Well, that's great, because that's our next topic.
Okay. I just want to say, why would somebody want to buy, let's say, the annual renewable term if they have a very short-term need for life insurance? What is short-term? 5 years. 5 years. Most insurance companies I don't know of any insurance company that will issue a 5-year level term insurance policy.
It's been a while since I've seen them. I agree.
Somebody has a 5-year car loan. They want to cover the car loan. I think the annual renewable term is the way to go, because the premiums will not be that bad. You're only going to hold it for at the most 5 years. So that might be an example. Okay.
Sure.
They are taking. In terms of level term, here we go. Okay. It's like any other term policy. Okay. In the sense that you have to apply for it, get approved, and you have to decide for how long you want the term to be. It can go anywhere from 10 years to 40 years. You also have to decide what amount of coverage you have.
Sure.
And like any other term life insurance policy, individual term life insurance policy, you have to apply for it.
Yep. Okay.
And then choose that coverage amount and the term length. Okay. Those two factors, together with the applicant's health, age will affect the premium cost. That's what's going to determine the premium cost. Once again, most insurance companies have a large gamut of insurance premiums. They can go all the way up to super preferred, smoker, non-smoker, or all the way down to rated. Okay.
Yep.
Okay. And if the insurance company, when they approve the applicant for insurance, the policy owner will pay the premium. They have choices how they can pay the premium: annually, semi-annually, quarterly, or monthly. But the point is, their premiums do not go up over the term of the policy. They stay the same.
Indeed. That's a big advantage.
That was probably be one of the two main advantages, again, for level term, is having the same premium and the same face amount of coverage. Okay.
Sure.
The disadvantage of level term, there are basically 3 disadvantages. One, at the end of the term, the policy is going to expire. If you bought a 20-year level term policy, figuring I only need an insurance for 20 years, but then you find out during the 20th year that you have a need for life insurance for the foreseeable future, you're going to have to go out and get another policy, because this 20-year term policy is going to be over at the end of the 20th year. And also keep in mind that you're now 20 years older. You reapply. Number one, you're going to be paying more in premiums, but also your health may have deteriorated, which means that you're going to be paying more in premiums as well. Okay.
Gotcha.
Second disadvantage, there's no cash value. Okay. All you're doing is paying for a death benefit. You build up no cash value. And the third disadvantage is the premiums that you paid, if you outlive the policy, are not going to be refunded to you when you at the end of the term of the policy. If you, God willing, outlive the policy, right? You bought the insurance as a means of protecting you from a big risk, the risk of leaving a family without income, or being, having to pay off a big debt. You didn't die,
Yep.
Therefore the life insurance proceeds were not needed. There go the policy, nothing's going to be refunded.
Sure. All right, up next, you got one that I think people are mostly going to run into this with their mortgage company offering it or something like that. That's where I see it the most. And that's decreasing term life insurance. So why don't you quickly take us through some of the nuts and bolts on that?
Yeah, decreasing term life insurance is a term life insurance policy with a set premium. You pay the same premium throughout the life of the policy, throughout the term of the policy, and it has a death benefit that decreases over the coverage period. Does not stay the same. Decreasing life insurance is often used to protect a specific debt, such as a mortgage. In fact, there's a term that the mortgage companies use for this type of insurance. It's called mortgage protection insurance, MPI, mortgage protection insurance.
Mm-hmm.
Okay. The coverage for the policy for this, the amount of the term is the coverage lasts as long as the debt, and the benefit decreases as the debt is paid off. Okay. So, it's not that popular. And by the way, Dan, an insurance company cannot require you to have any type of insurance.
Sure.
The insurance company cannot say, well, we approved your mortgage, but you have to make sure that in case you die sooner or later, that the mortgage proceeds are going to be paid off. Therefore, you are required to buy life insurance. They can't do that.
Agree.
That's illegal.
Yep.
Okay. There used to be something called credit insurance. Credit card companies used to offer, to say, we can get you some real cheap life insurance to cover your credit card debt.
Yeah, right.
Yeah, right. It's really cheap. Magic cost. So
and you kind of round out with one that has popped up on the horizon, I've noticed over the last 10 years. And that's called a return of premium life insurance policy. Why don't you talk about that a little bit?
Yes. And before I forget, Dan, in that column, I did another comparison. In this case, I did a comparison of level term insurance with
decreasing. Yep. Okay, right there on page 4. I see it.
So you may, when you read, when our listeners read that column, they should look at that because it really breaks down the differences between the two. Okay.
Yep.
Return of premium life insurance. Okay. A return of premium life insurance is another type of term life insurance. As term life insurance, the life insurance coverage lasts only for a set period of time and then expires at the end of the term. But unlike traditional term life insurance, the insurance company will refund the policy owner for all premiums paid when the policy expires.
Mm-hmm.
Now, what is the cost of this? Dan, can I ask you a question?
Yes, absolutely.
Are insurance companies out to make money?
Yes, they are, Ed.
You've noticed that, right?
I have noticed that. Yes.
Yes. Do you think an insurance company is going to offer someone a return of premium life insurance policy? Let's say it's a 20-year return of premium term life insurance policy. So let's say $500,000.
Mm-hmm.
Do you think they're going to charge in terms of premium costs, the same amount of premiums to the applicant for this type of insurance compared to if that same applicant bought a level term life insurance policy in which they're not going to get a refund of their premiums at the end of 20 years? Do you think they're going to it's going to be the same cost?
No, Ed, I do not think it'll be the same. I think it'll be quite a bit higher.
And you're absolutely correct, Dan. Absolutely correct. The policy owner who applies for this as the insured is going to be paying a much higher premium in order so that if they outlive the policy, they'll get a refund of all those premiums paid. Okay.
Yep.
Is there any advantages to this? Okay. Yeah. You get your premiums paid back. You get them paid back in a lump sum payment. And by the way, because insurance premiums are always paid with after-tax dollars,
Mm-hmm.
the lump sum payment you're getting back of all previously paid premiums are not going to be taxable income.
Mm-hmm.
Okay. Second advantage, I call it quote unquote forced savings. That's why I put quote unquote. Okay. Okay.
I don't know, Ed, that feels a little bit like sending the IRS too much just so you can get it back, but go ahead.
Yeah. I don't think this is forced savings. Let me explain why. Okay. What are the disadvantages of return premiums? The disadvantages they're basically I have two main disadvantages. One, as we just discussed, the cost of the insurance is more expensive compared to, let's say, an annual renewable term insurance or a level term or a decreasing term. You're paying more premiums. Okay. And the insurance company, when they pay that lump sum back to you, is not going to give you any interest. They're not going to add to it. That's why it's tax-free, because you're getting back the original principal that you paid, the premiums you paid. Okay.
Gotcha.
In my opinion, those extra premium dollars you're paying for this life insurance to get them back are much better invested putting it into something like a Roth IRA.
Sure.
With the Roth IRA, the money you're putting in there is growing. It's getting interest, dividends, capital gains. Do you have to pay tax on those capital gains? No. When you pull the money out of a Roth IRA after age 59 and a half, all that investment in all the accrued earnings you accumulated are going to come out tax-free.
Mm-hmm.
Much better deal. But here's the other issue. In my opinion, not only are you not making money, I think you're losing money on this. Why?
Certainly possible. Yep.
If they're not paying you any interest, you're not paying you any interest on your premiums. When you get that lump sum payment, you're not going to get any interest paid on that lump sum payment. Over the years, you've been paying those premiums. And because of inflation, do we have inflation now?
Oh, we have inflation, Ed.
Oh,
yep.
Yesterday's report for August, like 8.6% something. Consumer Price Index. You're going to be losing money when you get that money back. Just the present value of money, you're losing.
Sure.
On deal. My opinion, return of premium is not a good deal.
I would agree, Ed. I would agree. Now we've got a little extra time here, which is good. So wanted to see if we can't talk at a high level about what I consider to be the two general types, and we can talk a little bit more about this, of categories for permanent insurance. One being a traditional whole life policy, and the other being some iteration of universal life. And let's go ahead and jump in on universal, because in the last podcast we talked about it becoming popular in the 80s when interest rates were high. And from my side of the table, the big thing that I came to understand about universal life, any type, so whether it's a traditional with an interest rate, whether it's an indexed version, whether it's a variable universal life, is there's an unbundling of the product. So where with traditionally you just had whole life and term, and whole life is more expensive and you paid more for it, and there was a cash value and you got reports on that and that sort of thing. With universal life, you can sort of see the multiple parts to it. You can see the internal cost of as they describe it, the term life insurance. So yes, a universal life has a term component, but also there's an accumulation fund. It might have an interest rate. It might have an index credit. It might have, a variable account attached to it that's going to that money goes into. And then you're going to have how your rate of return is determined. And there's even kind of a new wrinkle that came up in the last 10 years, where there's universal life with a guarantee, meaning if you pay a minimum premium into it, it's going to stay in force at least for X many years, in which case it's to behave a lot like a term. So I'll share my thoughts, and then I'm interested in yours. I really believe that universal life is primarily a term policy with a side fund that you can see. That doesn't mean bad, that doesn't mean good, but it's just understanding. And further, there are places that can be adjusted within it typically. So the company can raise and lower the cost of the internal term insurance. The company can raise and lower the interest rate. If it's an indexed product, they can say, okay, we're following the S&P 500, but there's a cap to what you could get, or there's a participation rate, and it'll only be 65% of what the S&P does, and that type of thing. And so my thought on it is it's kind of stuck in the middle. There can be some worthwhile uses for it, but there are also a lot of moving parts. And you asked me the question earlier, are insurance companies in the business of making money? Yes. And that doesn't make them bad. But I think it also means that if there's a part that can be adjusted and it works better for the company, or if it works better for the insured, I think the company is always going to want to turn that dial towards the company. So what are your thoughts on universal life in general? And then we can, time permitting, maybe talk a little bit about the underlying funding of it.
My thoughts have been, unfortunately, the horror stories I've heard about.
Oh yeah,
what's happened with this, and to my understanding, when I started in this business back in the early '80s, and universal life came out, I had clients who did take advantage of the initial offering of the universal life insurance policies, with the idea that the interest rates were so high that they'd be better off putting this money in this policy, knowing that any earnings they get within, in the cash value are going to grow tax deferred.
Absolutely.
And that was very attractive.
Sure.
The other thing that made it attractive is that the insurance company said to the policy owner, well, that because interest rates are so high and there's a lot of earnings being paid out, interest being paid out within the policy, you can sink more money into the policy. If you have some available cash you want to put into policy, you can do that, and it'll keep growing. And it may come to the point that you have so much cash value that you can stop paying the premiums.
Yep.
That there's enough there's enough cash value to pay for the death benefit, for the guaranteed death benefit. You can also borrow against the policy.
Yep.
Take out loans, and you won't have to pay those loans back again, because there should be enough cash value, enough earnings building up cash value that will really pay the loan on help pay down the loan, if not get rid of it. Well, Dan, that was all fine and good when interest rates were 10 to 15%.
Sure.
But then interest rates started coming down in the 90s.
Oh yes. Yep.
Way down. And some individuals who really took full advantage of borrowing against their universal life insurance policy stopped paying the premiums. The amount of their cash value was decreasing over time, to the point that the insurance company said, listen, you don't have enough cash value in these policies. You have to start paying premiums.
Yep.
And the person said, I don't have enough money to pay what has to be paid in order to get that loan paid off within the policy. They stopped paying and the policy lapsed. They lost their insurance coverage.
Yep.
So my point is this, that not all the I's were dotted and T's were crossed for people who bought these policies. The consequences of low interest rates was not pointed out. They didn't ask the question, well, it's nice that interest rates now that I bought this policy, it's now 1983. I love it, the fact that interest rates now are 15%, but just in case interest rates go down and I borrow against my policy, what is going to happen? They didn't ask that question. They found out the hard way and they lost their life insurance.
Yep. And that's a great segue, Ed, because that's another risk with anything that would be variable in the mix. So, under this universal life heading, you also have the choice of doing a variable universal life where the funds are invested in a suite of mutual funds.
Yeah.
And Ed, are we in a bear market right now?
It definitely is a down market. I don't know if he reached the part on the definition.
Well, actually we have. Yep.
Okay. So we are in a bear market now. Let's go back when variable life insurance started, I think in the 90s, Dan.
Yep.
In the 90s, the stock market, between, let's say 1992 through 2000 was doing terrific.
Absolutely.
And people would buy these variable life insurance policies to take advantage of the stock market. They would invest in stock mutual funds. What happened between 2000 and 2002? We had a down market, Y2K, all that stuff. Ditto for what happened in 2000, 2006, 2008 to 2010. The same thing happened. Individuals who had bought these variable life insurance policies, knowing they'd have to pay a minimum premium, but because the value of their cash value went down, I say a minimum premium to sustain the death benefit. But if they had borrowed against these policies, they'd have to pay much more in premiums in order to get those loans paid off.
Absolutely.
Definitely. Again, horror stories, Dan. Individuals who bought these policies, I call it, were sold on them.
Sure.
They didn't go out and buy them. They were sold. Someone told them, I got the best thing for you. Without knowing, the person buying it didn't really know the full consequences. They were not educated on it.
Yep, very true. And sort of last comment on there goes to the index side of the house. And here's this is my opinion. Wait and see what our compliance department feels about this. When it comes to an index type of thing, you're going to be earning an interest rate. That is the construct of it. But what it's saying is that your interest rate will be determined by the performance of this index. And where that gets tricky is with something called a participation rate or a cap. And so, for example, if the index that you've chosen, the S&P 500, and the S&P 500 has had a great year and did 30%, you go, wow, I can't wait to look at my cash value. And you go, hey, wait a minute, why didn't it go up by 30%? And that's when you find out, and I'm not saying that anybody's trying to deceive you. It is in the contract. You can find it. And if you have contracts and you just want somebody to look them over and help you understand them and see if they're working for you, we're happy to do that. Everybody at Serving Those Who Serve has all the credentials to do that. But what you will frequently find is that you're earning consistently over time about 5%. And the reason for that, and this is not to say bad or good, insurance companies are some of the greatest bond investors in the world because that's where they invest their money. And I think they do it better than just about any organizations out there. But most of the time, you're going to see bonds in that middle digit area, 4 to 6%. So they can't really pay you more than they're making. So it's just important to understand how these things work. Again, Ed used a term earlier, and I think it's vital. It's suitability. Okay. These are all tools, and they are built to perform certain ways. And do they fit the job that you want? And that's where the term suitability comes in. So the biggest thing, and Ed said it in the last podcast, I'm pretty sure he said it here. If you don't understand it, don't buy it. Don't put it in place. stay on it until you understand it, because I'm not saying these things are bad or good. I am simply saying that when they unbundled them, there are more things to consider and more things to understand. So Ed, let's kind of round out and talk about whole life, because this is something that's literally been around since the end of the Civil War. Whole life has been around for a long, long time. And it's really funny because it's gone through phases where, during the 80s, when interest rates were so high and whole life policies were just earning 5% inside, it's like, oh, they stink, get rid of them. But there is a stability to them that I consider to be attractive if you understand how they're going to work and what they're going to do for you. So what are your thoughts there?
I agree. If someone is, let's say, reached a point in their life in which their current insurance, term insurance, is going to be running out, or it's going to get much more expensive. I'll give you an example. A federal employee is retirement. They're within 5 years. Let's say they're in their late 50s, early 60s, and they know they're going to need life insurance for the foreseeable future, anywhere 15, 20 years, maybe all of their retirement years. And they know that FEDLIFE is going to be very expensive. The only way FEDLIFE is not expensive if you take when you opt for the reduced FEDLIFE basic, that goes down to 25%. Well, that's not going to be enough life insurance. They need more. And they're older now. If they're under 65, yes, they could buy term insurance, but it's going to be very expensive. Then in that case, the only other choice would be to buy some type of cash value permanent life insurance, and probably the cheapest one would be the whole life, because whole life is designed to so-called endow at a certain age, meaning it reaches its face amount. And particularly if they have a current term policy that's going to run out within a couple of years, they are advised maybe to check with the insurance company to see if they could convert. We talked about this earlier, whether they can convert that term policy to a whole life policy. Once again, with not having to furnish evidence of insurability. It's guaranteed issue.
Mm-hmm.
This may be their one and only choice. In looking over whole life policies compared to other type of policies, including universal life and variable life, whole life would be cheaper. And this might meet their needs.
And Ed, I'm sure you have the same experience that we've had, where we're meeting a new client and they'll almost talk about it like they feel like they made a mistake, where they've got a whole life policy that they've had for 30 years. And they show it to you and say, yeah, I got this, or my dad got this for me, or something like that. And, I don't know what I should do with it. Should I get rid of it? And when we take the time to walk them through it, they're almost always shocked by how well it's doing right now. So for example, somebody's got, a whole life policy they've had for 30 some years. They may even be the point where they don't have to pay premiums on it anymore because, the dividends can take over the premium. But I'm showing them that their cash value is growing by 5.5 or 6%. How does that look compared to a bank? It looks pretty strong. So have you encountered that as well, where people come to you with older whole life policies and they almost feel like they made a big mistake and they didn't want to tell you about it?
Dan, I have right in front of me my $25,000 Gerber. I have a Gerber policy that my grandparents gave to me. A Gerber policy when I was born 71 years ago.
That's awesome.
And it's reached face value.
That's awesome.
$25,000. Dan, what do I do with it?
Well, here,
go ahead.
I will give you a funny story on that. So my grandfather was actually a really great believer in insurance, and he bought policies on his kids pretty much around the time they were born. So my Aunt Dell got mad at her insurance company because, get this, So at this point, she was in her 90s, and the way she had set it up, where she was now receiving the dividends from the policy in cash.
Mm-hmm.
Okay. And so it was long since enough to pay the whole premium, and she was getting the excess in cash. Well, one year she got a 1099. And she was so furious because she had never gotten a 1099 before that she stomped into the MetLife office and told them she wanted to cash it in, which they happily did. And when my mother told me that story, I said, pretty please, with sugar on top, if any of your brothers or sisters have this, please have them call me, because the reason she was getting 1099s is now she had received so much in dividends back that it was more than was ever paid into the policy. She still had the policy, so she still had the coverage. The cash value was still in there, and they were effectively paying her to keep it. So then, less than a year later, enraged again because she got the whopper 1099 off all the gains associated with that. So these whole life policies they are the greatest thing to have later in life. They maybe don't look so good in those first few years, but again, your Gerber policy, my aunt's policy, it's really amazing how they look towards the end.
Well, I do get those questions about what do I do with my whole life policy. I really don't want to pay tax, cash it in. Are there any alternatives? And I discussed something called, I know we're not going to have time to talk about this today. There's something called a 1035 exchange.
Sure.
In which you can exchange a cash value life insurance policy like whole life for an annuity. Now, it's going to be a fixed annuity. It's not going to be a variable annuity, but the insurance company will, issues annuity, will take all that cash value and turn around and pay you for life. That's what an annuity is. And will you have to pay tax? Yeah, but in bits and pieces, as opposed to cashing the policy. Yep. It's called a 1035 exchange. You could exchange the policy for another type of life insurance policy if you want.
Sure.
And why it's called a 1035 exchange is because it's similar to a real estate exchange, in which you exchange one rental property for another rental property, or you buy land and you're going to sell the land. Instead of selling the land, make a profit, you're just going to buy another, let's say, piece of land, or you can buy an office building or a rental property and take the cash and plow it into that property, and you wouldn't pay tax because you're not really selling the land. It's called a 1035 exchange, which we can talk about at a different time.
Sure.
One last thing I want to mention, Dan, you're talking about the cash value. Very important discussion, and everything you said is absolutely on the mark. But what I also tell individuals when it comes to these cash value life insurance policies, be very sensitive to the expenses associated with these policies.
Yep.
Mortality expenses, the expenses of the mutual funds or open-ended funds that
100%.
In general, when people ask me my opinion about investments, I'm very general. In addition to please understand what you're investing in. Don't just go in because somebody said it's a good investment. Know your goals, know what's involved here. But also, when it comes to your investment return, I always say it's not only what you're earning in your investments, it's also what you're keeping in the
Absolutely.
end. After you got to pay all these expenses, including taxes, by the way, let's say surrender fees, back-end commissions, things like that, you may end up with a lot less money than you think. So be very careful about this, what all these associated expenses are with any type of cash value life insurance.
Agree, Ed. And I think that's a good place for us to break, folks. This one's going to stay up for a long time because this really isn't time sensitive. You will see across our suite of podcasts, we have some that are evergreen. As a matter of fact, we may even start labeling those as such. This is going to be something that you can go back to and share with your friends. Seriously, if you have some questions about coverage that you have and you're just looking for a second opinion, hit us up at Zurndorfer Serve. We'll help you any way we can. Ed, once again, thank you for everything you do for the feds, everything you do for us. We get better every day by working with you. We're very grateful for that. And folks, that is a wrap. We are serving this to serve. Be sure to subscribe to this podcast on our YouTube channel and Spotify. Please remember to share it with friends and strangers. Don't forget us on Twitter and LinkedIn. And do not forget those live webinars every single week. Just go to stwserve.com. You'll see the webinar button. Hit it, and you can go to the menu. The guru will come to you. Be sure to read every week in the Fed Zone at stwserve.com, fed-zone.com. And don't forget to sign up for the weekly serve. So for Ed, the crew at Serving This Serve, and me, Dan Sipe, good luck, Godspeed, and above all, remember, it is your Fed life, so please make it a great one because you deserve it. Stay well, everybody. We are out.
Thank you for listening to the FEDLIFE Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated and does not endorse the opinions or services of any of the quoted professionals or their respective firms. Any opinions are those of Dan Sipe and not necessarily those of RJFS or Raymond James. This case study is for illustrative purposes only. Individual cases will vary. Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations.
Neither Raymond James Financial Services nor any Raymond James financial advisor renders advice on tax issues. These matters should be discussed with the appropriate professional. Investing involves risk, and you may incur a profit or loss regardless of strategy selected, including diversification and asset allocation.